Welcome back to Real Estate Simplified. Jacob, you are a real estate investor extraordinaire. Tell us all about joint ventures. What do we mean when we say a joint venture?
Yeah, so joint venture is a pretty general term. It could apply to a lot of different business spaces, but if we're talking about real estate specifically, it's really just two parties coming together and forming a business relationship. So typically, if you look at real estate specifically, most joint ventures follow this basic structure. You'll usually have one active partner. This is usually the person who's experienced in investing in real estate, knows how to acquire deals at good value, manage renovations, buy materials, manage tenants, manage maintenance. They usually have the connections to, the really good mortgage agents, the really good realtors to work with in your area, all that kind of stuff. Then you usually have a money partner. Now, the money partner would be providing the down payment for the transaction, usually getting the loan from the bank in the form of a mortgage, and sometimes, financing a lot of the renovations in the project. So there's a lot of people in this country, in Toronto or Vancouver, these major cities, where they've seen firsthand that real estate's an incredible investment, right? But know what? They might have a really, really busy career, and they might have 3 kids to take care of, and they might want to spend some time with their family, and they don't want to be driving 2 hours to, an investment market that's really profitable every single weekend, learning how to invest in real estate while still being like a master of whatever business they're running that's kind of created their nest egg in the first place. So what they'll do is they'll team up with local investors who know what they're doing, take a smaller split of the equity in the deal, but have a more guaranteed return. And generally what you'll find is if you're working with the right people, those returns you're getting on those joint venture transactions are far superior than what you get in, a stock market portfolio or something like that.
Yeah. Plus, you're able to avoid making a whole bunch of mistakes. And we've been around long enough. We've made those mistakes ahead of time. So it kind of expedites the learning curve by working with an experienced partner.
Absolutely.
Yeah. And when does working with a partner make sense? Like if somebody's sitting at home right now and they're interested in building a portfolio, when does it make sense for them to seek out that other partner?
So I think, it can make sense in a variety of different circumstances. I think usually it's born out of a need. So usually what you'll find is some people is at a point where they can't really qualify for another mortgage at a bank. Either their income situation just is not high enough, or they've accumulated so much debt that, banks just really don't want to touch them, right? So that might be a time where a real estate investor says, hey, you know what, now I might want to seek some outside partners to bring them inside my investment strategy. It might be that you come across an investment opportunity that is just so large that you need more capital involved, right? And it might be another side. So one thing that people don't often think about is I've done a lot of deals as the active partner, but I recently had a deal brought to me by another investor who needed a money partner, and the deal itself was so good, I decided to switch seats and go in as the money partner, right? So you might find that being the money partner might be the only way you actually get access to the deal, right? But if you're, as someone who's looking to bring in partners to fund some of the real estate deals, it's usually born out of a need kind of thing versus, now's the time or something like that.
Yeah, and would you say that an investor should have a couple deals under their belt before they seek out a partner, or should you partner up from the start?
I think, you'll probably get a different school of thought on that depending who you ask. If you ask me, I think you should 100% have a few case studies to sell anybody in order to invest with you, because if you're at the point where you're soliciting money to invest in real estate and you don't have any case studies of success, well, your terms better be really good because you're a pretty risky investment at that point, right? Yeah. So I think, you definitely want to have some case studies, and just in general, if you do want money partners involved in your real estate business in the future, if you haven't figured out a way to save up enough money to maybe get yourself into one property on your own, you're probably not instilling too much confidence in a money partner to invest with you anyways. So I think definitely you want to get going on your own, have an actual portfolio you can sell so you can say, hey, had you been my partner on these 3, 4, 5 deals, here would have been your return today. That's a lot more powerful than promising something that's theoretically unexpected in the future.
Yeah, well, 100%. And where would somebody start looking for a potential partner?
I think, with most people, it starts in your personal sphere, right? You want to turn a lot of conversations to real estate. I think the most important thing is you want to be a resource for people. So for me, I'm not necessarily soliciting joint venture partners, but I am speaking to a lot of people about investing in real estate and encouraging them to do so. Now, when there's a gap where they say, you know what, I would love to invest in real estate, but I'm too busy, but I have my kids on the weekend, but this. That's when it's kind of opened the door for you to have that dialogue regarding, hey, well, we could potentially partner on something. We should get a coffee and see what that might look like.
Yeah, no, 100%. And it sparks the conversation, right? And what would you look for in a potential partner? Because I've got my own horror story. I think everybody, when they've been in real estate long enough, they have a partnership that doesn't go right. So what should you look for to have a relationship that does work out?
There's a lot of different things, right? I think, the obvious things are, they have to have money, they have to have borrowing power with the banks, right? But another thing is, this is a long-term investment. You might be tied to this joint venture money partner for 5, 10, 20 years or longer. So generally, you probably should like the person. You should probably enjoy having dialogue with them, right? Because that's going to be pretty important. I think one thing too is just assessing their liquidity and exit strategy up front. So if someone is getting married in 2 years and they're all of a sudden going to need the money, or someone has their kids going off to university in 3 years and they're all of a sudden going to want the money at that point, you just want to kind of know what you're getting involved with. I think one thing that is really ideal if you can have it, but it's very hard to swing, is if you can get a joint venture money partner who's kind of really in the same age range as you. You have the same life trajectory going, so that if you get an investment, they might be looking to retire in 10 years, but if you get someone who's your age, you might both be looking to retire in 20, 25 years. So you can kind of ride out that investment a little bit longer. But I think that question is really going to be tied to the specific investor and what they're looking for.
Yeah, it all comes down to core values, I guess you could say, right? And what would you say are some common joint venture mistakes if somebody's looking to get into joint ventures?
Yeah, I think the main thing is maybe like overselling your value proposition, right? If you're saying that we're going to buy this property, we're going to renovate it, and it's going to appraise at this value, and the value that you're saying it's going to appraise as is the only single highest comparable sale that exists in the market for that type of property. Well, maybe you're setting the bar a little bit too aggressive for what might actually take place. I think the right thing too is just setting expectations. What I do with a lot of my joint venture partners is we decide to move forward with an agreement, we decide on a certain property type, and we actually write a letter. So it's a letter of intent that says we are going to buy a property in this neighborhood, in this price range, and it will rent as 2 units, and this is our expected rent. So that when a property does come up, you know that you have to pull the trigger pretty fast, and you've already predetermined that, hey, we agreed on this, and everyone's kind of on the same page. Because there's going to be a lot of different stakeholders. You might have a joint venture partner, but they have family members, they have things like that. So I think it's all just about setting the expectation correctly, and then in addition to the property, it's setting the expectation on the schedule. So we're going to take possession on this date, the renovation is going to run on this date, we expect the refinance on this date, you're going to have your return investment on so-and-so date. So just really being very, very clear, that way everyone's on the same page, and then of course you just have to deliver on those parameters.
Yeah, hey, good stuff. Well, coming up after the break, what impact is the hot real estate market having on lending? Stay tuned.